2016 was a year of many surprises. Oil prices staged a big comeback amid the first OPEC production cuts in 8 years. Long-term interest rates initially fell to record lows in North America, turned negative in Europe and Japan, only to morph into the biggest bond rout in decades. And perhaps most surprising, the outcome of the U.S. presidential election and powerful equity rally that followed. 2017 could be equally eventful. Here are just some of the issues and events that investors will need to watch for as they navigate a possibly rocky economic and political landscape next year. Hands down, the most important issue is the impact of Donald Trump's policies on the U.S. economy and its major trading partners. Cutting taxes, boosting infrastructure spending, and reducing regulations could materially lift U.S. GDP growth. Big great news for Canada. But the key word is could. Congress will determine how much stimulus actually makes it through legislation. Despite the single-party government, many Republicans oppose measures that would increase the budget deficit, suggesting that reining in tax deductions could temper much of the boost from lowering tax rates. Congress will likely also push back at Trump's contentious proposals on protectionism. Good thing, too, as steep tariffs on U.S. imports could disrupt supply chains and business confidence. While the U.S. economy might not get hurt as badly as Mexico or Canada in a trade war, it wouldn't leave the battlefield unscarred. Even if Congress passes a good part of stimulus and reins in the president-elect's worst tendencies on trade, investors will need to worry about one consequence of fast growth: inflation. Aggressive fiscal stimulus when interest rates are already low and the economy is near full employment could fan wages. By one measure, U.S. wages are already rising the fastest in 8 years amid growing labor shortages. Rising inflation would be a problem for the Federal Reserve, bondholders, and the economy. Faster wages stoke inflation, the Fed will need to tighten forcefully. Since recessions are often caused by higher rates, an active Fed could see investors hit the sell button. Even if the Fed doesn't move forcefully next year, the U.S. dollar will likely strengthen further, as nearly every other major central bank is either pressing on the easing pedal, such as the ECB and Bank of Japan, or is parked firmly in neutral, such as the Bank of Canada and Bank of England. Stronger greenback will slow the U.S. expansion, could create problems for emerging market companies that have borrowed heavily in dollars. Outside the U.S., investors will need to watch elections in Germany and France, as well as the outcome of Brexit negotiations and the fragile health of Italian banks. The elections could usher in populist parties with isolationist policies, which could ultimately lead to slower European growth and the fracturing of the single currency union. This would send reverberations through global financial markets. Also keep a close eye on oil prices, given their impact on Canada's economy. The OPEC deal will be reassessed in 6 months, and an unraveling would send crude prices spinning lower, delaying the recovery in Canada's oil-producing provinces. Finally, the world's second largest economy, China, will remain a flashpoint. While the government has managed to stabilize the economic slowdown at above 6%, may have simply traded off near-term stability for longer-term imbalances, such as rising public debt and a property bubble. Nervousness has led to record capital outflows from China and downward pressure on its currency, risking further capital flight and instability. To wrap up, like this year, 2017 could bring many surprises. As an investor, you will need to stay vigilant so that you are not too surprised. So keep a close eye on U.S. inflation and oil prices, Federal Reserve and greenback, European elections and China's economy, and of course, the words and deeds that come out of the White House and Congress. Thank you.